Very warm good evening to one and all. On Erode branch of SIRC ICAI, I warm welcome to one and all. Today's topic accounts audit and CSR provision under the Companies Act 2013. I herewith heartily welcome to our today's speaker. He is BSc FCA, grade CWA, ACS, and a registered valuer in the securities and financial assets. He is secured 5th rank on all India basis in CS final examinations. He is almost practicing more than 3 decades. He is in managing partner Bhadri and Vijay, CS Coimbatore, specializing area in accounting standards and finance. A faculty in the seminars and meetings organized by the SIRC of ICAI and also ICWAI and also ACS CAI Coimbatore. He has been addressing commerce and MBA students and faculty members in colleges and universities on various topics, including accounting standards, Companies Act, and finance. He was chairman of Coimbatore SIRC of ICAI in the year 1999. He is also committee member of Auditor Association of Southern India. He has authored the book in the name of Inventory Valuation as published by ICAI Coimbatore. In this few words, I welcome K.Bhadri Narayanan sir. Very good evening, sir.
Good evening.
Welcome.
Good evening.
You are in yours.
Shall I proceed?
Thank you.
Hello, shall I proceed?
Definitely, sir. You may take care.
Okay. Thanks, Chairman, for the nice introduction. Thanks, Erode branch, for the opportunity given to speak to the members of Erode branch who are very knowledgeable. Senior members are there. This is something of a discussion. It would be better if the participation is lively. Perhaps after completion of the session, the viewers can get into questions and put me into some sort of questions, which I would be happy to answer to the best of my ability and knowledge. With that brief introduction, let me proceed to the topics that has been assigned to me of accounts, audit, and CSR provisions under the Companies Act 2013. Whatever that I discuss here would be relevant mostly for the financial year 31st of March 2020. That is the current financial year that has ended. And now we are in a difficult epidemic season. This shall pass and we get into normal mode as soon as possible. With regard to accounts, the first point that we have to understand is financial year. Earlier under the Companies Act 1956, the financial year can be anything of 12 months or even less than 12 months. But under the Companies Act 2013, the financial year can only be ending on 31st of March every year. 31st of March every year, like the Income Tax Act, where the previous year is to end on 31st of March every year. The financial year of a company, as defined in Section 241 of Companies Act 2013, should end only on 31st March. You don't have a choice to choose any other period of 12 months or whatever. Therefore, you can't have a December end or you can't have a June end and all that. The financial year has to close on 31st of March every year. This was not the case in the earlier Act, Companies Act 1956. But nevertheless, there are some options. For a holding company or a subsidiary or associate company of a company incorporated outside India and is required to follow a different financial year for consolidation of its accounts outside India, the central government may, on an application made, allow any period as its financial year, which means if you are a company located in India, but your holding company is abroad, or your subsidiary is abroad, or your associate is abroad, incorporated outside India, and that holding company or subsidiary or your associate which is outside India is required to follow a different financial year. Say, for example, you have a holding company abroad, and that holding company follows calendar year. December is the year ending of the holding company, and you are the subsidiary located in India. If that is the case, then you have to make an application to the central government, and the central government may give a leeway or permission to have a financial year which need not end on March. Say, for example, if the financial year is ending on 31/12/2019 of this year, then the central government will permit. This has to be done before the close of the financial year. Therefore, on an application made to central government, only for the specified reasons, you can't just like that apply and take a different financial year. There has to be a necessity for consolidation because the other entity located abroad is closing its books on a different day, not 31st day of March every year. And therefore, only under this condition, the financial year can be differently ending than 31st day of March. Otherwise, for all practical purposes, the financial year of a company has to end on 31st of March every year. This is financial year. The next is financial statements as defined in section 2 within brackets 40. Again, under the earlier 1956 Act, there was no definition for the term financial statements. Fortunately, because we have been using the term financial statements for a long time, but the financial statement was not defined earlier. Now, under the Companies Act 2003, the term financial statement has been defined. Balance sheet as at the end of the financial year, which has to end on 31st March. Profit and loss account, or for a company carrying on activity not for profit, the so-called charitable entities and all that. An income and expenditure account for the financial year. Then a cash flow statement for the financial year. For one-person companies, OPC. For small companies, SC. And for dormant companies, DC, which are defined under the Act, you need not prepare cash flow statements. For all other companies, you should prepare cash flow statement. If you are a small company, there is no question of any cash flow statement. If you are a one-person company, there is no question of any cash flow statement. If you are a dormant company, there is no question of any cash flow statement. Then a statement of changes in equity, if applicable. As of today, it applies only to Ind AS entities, and therefore, let us not be very serious about this statement of changes in equity. Roughly, the statement of changes in equity is the movements in P&L, movements in reserves, general reserve, capital reserve, and all that. The term equity means share capital plus reserves and surplus. Put together, the term is taken. That equity term refers to share capital and reserves and surplus. That is something of a statement of changes in equity. Obviously, as I told you, it applies only to Ind AS companies. All the explanatory notes that you attach, notes on accounts, schedules to accounts or notes to accounts, all other documents are included in the term finance. It's a very exhaustive definition. Therefore, the balance sheet, profit loss account or income and expenditure account, cash flow statement except for OPC, SC and DC, one-person company, small company and dormant company, statement of changes in equity, if applicable, only for Ind AS, and all other notes that you append to the the above balance sheet or P&L shall be fully all put together is known as financial statement. This is just to understand that the term financial statement is fully defined under the, so wherever you find the term financial statements under the Companies Act, you must understand that refers to all these statements. The format of financial statements for Ind AS entity, there is a big format appended in Schedule 3. There is one Schedule 3 which prescribes the presentation and disclosure formats of the so-called financial statements. Most of entities in Coimbatore or Erode are non-Ind AS entities, which may be private or public. For non-Ind AS private and public limited companies about which we are more concerned, the accounts are to be presented in accordance with Division 1 of Schedule 3 of Companies Act 2013. So Schedule 3, there are two divisions. First division of Schedule 3 applies to non-Ind AS entities, and there is one Division 2, that is second division of Schedule 3, that applies to Ind AS entities. For the time being, we are not getting into Ind AS entities because most of the companies, as I told you, in this region or in this part of the country are companies which are non-Ind AS, small private companies and unlisted small public limited companies. So for those companies, the Division 1 will apply. The Division 1 of Schedule 3 of the Companies Act 2013 prescribes requirements, instructions, and presentation format for financial statements of companies. The format is very important because lot of times the chartered accountants or the members of the institute get queries from either from CA Institute under professional deliberations or professional misconduct proceedings, or from the Ministry of Company Affairs, Registrar of Company Affairs. All those people send you questions because the format is not maintained properly or the format is not taken care of properly. Inside the accounts, there can be many issues, but it is better to maintain the format and adhere to what is given in Division 1 of Schedule 3 for non-NDAS companies to avoid such sort of letters from MCA or from the CA Institute. Therefore, it is really necessary to understand the format. To the extent possible, strictly adhere to the formats given. I am not going to elaborately discuss the format, but please ensure that Division 1 of Schedule 3 format is correctly followed and accounts or the financial statements are prepared in accordance with the Division 1. Largely, you can't deviate at will. Small, this way, that way, deviations are okay, but largely you have to follow. Some presentation requirements that are required, we will see in the coming slides. The structure of Schedule 3, Division 1 is like this. The first part of Schedule 3 Division 1 is general instructions for preparation of balance sheet and statement of profit and loss account. So what are all the various instructions that you have to consider to prepare the balance sheet and the statement of profit and loss account or the income and expenditure account, as the case may be. Then the second one, part 1, form of this form is very important. As I told you, adhere to the form, don't miss out any detail. Have the form typically prepared without any exception. If some items are not there for your company, put as 0. Otherwise, wherever the items are fillable, you please fill it up, but please maintain the format strictly in accordance with part 1, which is balance sheet. Then there are certain instructions provided in the part 3 as to preparation of balance sheet. Then comes the part 4, which is part 2, form of statement of profit and loss account. Here also, please ensure that you maintain the form diligently, correctly. There is income, there are expenses, there is tax, there is discontinuing operations, profit and all that. Everything you please maintain as such, because the profit and loss account should look like what is given in the format. Therefore, maintain the format very strictly. It is very much available in the Companies Act itself. You can also Google it up and get to know the form. Most of you might be doing this for the past 3-4 years and you must be aware of the form, but sometimes we miss some details, and please ensure that the form is fully adhered to. Then the instructions for preparation of statement of profit and loss, and finally the general instructions for the preparation of consolidated financial statements. The consolidated financial statements largely is to adhere to the form of balance sheet and form of P&L account as given in the earlier part 2 and part 4, but there are some more things that you have to do for preparation of consolidated financial statements. For the sake of brevity, I am not going to deal with consolidated financial statements, but please ensure that you also prepare the consolidated financial statements in the same format, further following the instructions given in part 6 of Division 1 of Schedule 3. These are all the structural understandings of Division 1. Then the salient presentation requirements of Division 1. If there is a conflict between accounting standards and schedule, AS will prevail. For example, there is something called cash and cash equivalents, which you have to disclose in the balance sheet. Cash and cash equivalents. The cash and cash equivalents, there are a lot of items mentioned in the Division 1. In the format, they have mentioned what are cash and cash equivalents. That is one thing. The accounting standard number 3, AS3 on cash flow statement, also tells you what are cash and cash flow statements, cash equivalents. Now, if you look into the accounting standard cash flow on preparation of cash flow, AS3, you will understand anything that is long term. For example, a bank deposit that is long term is not something of a cash and cash equivalent. It is something of a long-term asset. Therefore, if Schedule A says something and if accounting standard says something differently, then accounting standards only will prevail and the schedule will not prevail. AS has got a superiority over the Schedule 3. This is one important point that you have to understand as far as Schedule 3 is concerned. But taking Companies Act as a whole and the accounting standards, Companies Act is going to be superior. So if there is a conflict between accounting standards and Companies Act, Companies Act will prevail. If there is a conflict between the Schedule 3 and the accounting standards, AS will prevail. This is the broader difference. There is a specific provision in Schedule 3 itself that instead of this schedule, AS will prevail if there is a conflict. The disclosure requirements in Schedule 3 is in addition to the disclosure requirements specified in accounting standards prescribed under the Companies Act. Possibly, again, I'll take AS 18 as an example. In AS 18, there are a lot of disclosures required for the related party transactions. What is given under the Companies Act, there can be more or less. What is given in the accounting standards also could be different than the Companies Act, in which case you have to take both. The disclosure requirements specified in schedule or in addition to disclosure requirements specified in accounting standards. And obviously, all the disclosures that are required in the accounting standards plus the schedule are required to consider. Additional disclosures specified in the accounting standards shall be made in the notes to accounts or by way of additional statement unless required to be disclosed on the face of the financial statements. All other disclosures required by Companies Act shall be made in the notes to account. Therefore, please ensure that you are reasonably good in disclosure requirements of accounting standard. You also have to see the entire Schedule 3 full part and get to know what are the disclosures required there. Then if they are corroborative, if something is there in accounting standard or also in schedule, there is no problem. If Schedule 3 says something more, then you please take it. If accounting standard says something more, you please also take it and disclose. This is for rounding off. If the company's turnover is less than rupees 100 crores to the nearest thousands or hundreds or thousands or lakhs or millions, you can go up to millions. If the turnover of the company is 10 lakh, you can take 1 million, or you can say it is something like 0.1 million and all that. Therefore, the rounding off can be in terms of hundreds or thousands or lakhs or millions. That is the first point. Obviously, most of the companies in Erode or Coimbatore, the turnover could be less than 100 crores. Therefore, you can go up to millions and round off, and for the convenience of readers, you can round it off to millions or lakhs or thousands or hundreds. If the turnover is 100 crores or more, you can go for lakhs or millions or crores. Perhaps if the turnover is more than 100 crores, rounding off in crores are permissible. If the turnover is less than 100 crores, you can't round off to crores. But anything other than that, like millions or lakhs or thousands or hundreds, is possible. This is the rounding off fundamental. The balance sheet will look slightly decent and easier to understand if there is a rounding off fundamental that is followed. You can also, it is not that you have to round off. You can mention the figures as such. If the sales is something like 15 lakhs 45,000, 15 lakh 45,000, 250.14, you can mention the figure as such. If you want to round off, please follow A if your turnover is less than 100 crores, or B if the turnover is more than 100 crores or more. Obviously, comparative previous year figures are to be given with reference to any year. If you are preparing balance sheet or profit loss account for 31/3/20, the comparative figures will be for 31/3/19. This is very much required. Coming to one important aspect of depreciation provision, there is, like the Schedule 3, there is one Schedule 2 which discusses about the depreciation that you have to provide in books. Schedule 2 of the Companies Act 2013 discusses about the depreciation requirements, how much of depreciation is to be provided, what is the quantum, what are all the useful life, all that is mentioned in Schedule 2. Schedule 2 prescribes useful life for tangible assets. Earlier to this Companies Act 2013, under Companies Act 1956, there was no mention of useful life. There was mention of only rates. For plant and machinery, the rate has to be something like 15% or 10% or 20%, whatever. So 1956 Act mentioned only the rates of depreciation. Under the new Companies Act 2013, which is in vogue almost for the past 6 years, it came in 2014. Now we are used to this Companies Act, we are in 2020. There is only useful life. There is no depreciation rate over here. Given the useful life, the company has to compute the depreciation rate for the relevant asset. Schedule 2 prescribes there are two types of assets. One is tangible, the other one is intangible. Intangible assets like goodwill or know-how or patents or whatever, these are all intangible assets. Tangible assets, all of you know, plant and machinery, equipments, building, computers, all those are furniture and fittings, all those are tangible assets. Schedule 2 prescribes useful life for tangible assets. There is no useful life prescribed for intangible assets. We'll come to that in the next paragraph. But then for tangible assets, there is a useful life prescribed. Should you adopt the same useful life as prescribed in the schedule? Not necessary. You can have a different useful life, which means that tangible asset useful life that you take could be higher than what is mentioned in schedule 2 or lower than what is mentioned in schedule 2. There were some issues earlier and there has been amendments to say that it can be anything of a useful life. It can be higher. If the tangible asset useful life, if plant and machinery's useful life is prescribed as 15 years, you can take 20 years. You can also take 10 years. It can be on either side of the number mentioned in the schedule 3. You can have a different useful life. The only issue is you should be supported by a technical advice. If you take a different useful life, you must have a technical advice done by an expert. The expert can be inside the company or he can be outside the company. Therefore, there has to be a technical expert who will tell you that useful life is going to be something like this. So you can adopt your technical advisor opinion, or you can just straight away take the useful life prescribed in schedule 2. Normally, we take the useful life as mentioned in schedule 2 for convenience. But if you want to have a lower useful life or higher useful life, accordingly, you can also choose, but please ensure that you document it properly with a proper technical advice. Then the method of depreciation that you have to choose, it could be either SLM, straight line method, or the WDV, return down value method, or there is something called production of units method. This production of units method was not available earlier. Now this method is also possible. But for straight line method or WDV method or production of units method, you must have to have some sort of a basis. Can we pick straight line method as a matter of routine, or WDV method as a matter of routine, or production of units method as a matter of routine? At the accounting standard, it is slightly difficult. But in India, we do pick straight line method or WDV method or production of units method arbitrarily. Straight line method is very easy to follow. WDV method, the depreciation rate is slightly difficult to calculate, but that is not very difficult. Production of units method, if the useful life of an asset highly depends on the number of units that is produced from the asset and not just wear and tear or reflex of time, then you can pick that production of units method. Normally, production of units method you have to justify, because in that method of production of units, if there is no production in a particular year, the depreciation could be 0. This is the advantage or disadvantage, whatever you call. Therefore, the production of units method, where a rare possibility could creep in, whereby if there is no production in a particular year, the depreciation can be as low as 0. There is going to be a 0 depreciation in that year where there is no production. In SLM or WDV, we are not concerned about the number of units produced. We just go by time. If 1 year is over, we provide depreciation based on straight line method or WDV method, independent of the fact whether the asset has produced some units or not. The choice of method is an accounting policy, which means you have to justify your accounting policy. If you have taken straight line, you should say why you have taken straight line. If you have taken WDV, why you have taken WDV. Normally, most of the companies doesn't say anything. They just say for plant and machinery, straight line method is followed, or for electrical fittings, WDV method is followed. They just mention the method, but they don't justify the method. But technically, this is not seriously viewed, because you either take straight line method or WDV method, which are permitted in schedule 2. And therefore, this is not very seriously taken. You can just pick straight line method or WDV method. I would prefer just a straight line method, because it is very easy. Cost minus scrap value divided by number of years is the rate which you can easily work out. But WDV is slightly complex. Production of units method, you have to justify more. Anyhow, any of the methods that you choose needs to be justified. This is one point. Now, I did tell you that tangible assets, there is a useful life prescription, and for intangible assets, there is no prescribed in the rate in the schedule. There is no, except for toll roads, about which I'll just discuss later. No rate for intangible asset has been prescribed, or no useful life. No rate or no useful life. For tangible assets, there is a useful life. For intangible assets, there is no useful life. For intangibles, you have to go by the accounting standard number 26. Accounting standard number 26 is on intangibles that you have to take. As per AS 26, the suggested useful life is 10 years. I would possibly advise all of you to pick a useful life of 10 years whenever you depreciate or amortize the intangible assets like goodwill or patent or technical know-how or whatever, development expense, whatever you call. 10 years is the useful life. A longer period could be taken if justifiable. Depreciation method suggested in the accounting standard number 26 is always straight line or other methods if suitable, which means instead of finding out some suitable methods, we want us to pick straight line because it is easier. So useful life of intangible assets, you can broadly take it as 10 years. The method that you take is straight line method. Again, choice of method is a accounting policy. So SLM is taken, 10 year is taken for intangible. For all other tangible assets, go by the schedule 3 useful life and be done with it. If you want to have a different useful life of higher or lower, go by a technical advice. Then for intangible assets, for toll roads, all of us are aware of toll roads. That is very popular, constructed by L&T. We do cross a lot of toll roads by paying the toll fee, which is creating a lot of clutters and agitations. Nevertheless, the toll roads, if you are owning a toll road, created under build, operate and transfer, what we call as BOT or build, own, operate and transfer, BOLT, or any other form of public-private partnership, the amortization is based on revenue. So revenues are to be predicted. Suppose, for example, you have an intangible asset which is right to own the intangible assets given under build, operate and transfer. You have to construct, you have to operate for some time and then transfer the ownership to a later period. During that period of ownership of the asset, there is a revenue expected. If you estimate some 100 crores of revenue over 25 years of useful life, then depending on the revenue that you collect in the first year, you have to depreciate the asset. Total revenue expected over 100 years of owning the toll roads or 10 years of owning the toll roads is say 100 crores, out of which 10 crores is likely to be collected or collected in the first year. Therefore, 10 by 100 of cost of the asset would be the depreciation or amortization that will be charged on the concerned intangible asset. So this method, so it is a revenue based amortization. Otherwise, for all other assets, be it intangible or tangible, the normal other than these toll roads, you have to go by either the useful life prescribed in the schedule 3 for tangible assets. For intangibles, go by the mechanics or the prescriptions in AS 26. Pro rata depreciation for additions and sale of assets, all of you must be aware or might be aware because you have been doing this for a long time, for 6 years or earlier even in 1956. For additions from the date of addition till the accounting year end, for sale, the beginning of the accounting year till the date of sale, you have to take and provide depreciation. Addition has been made to an asset or where an asset has been sold, destroyed, etc. The depreciation on such asset shall be calculated on a pro rata basis from the date of such addition or as the case may be up to the date on which the asset has been sold or discarded or demolished or destroyed. Unlike in income tax where there is a 180 days, this way that 180 days more or up to 180 days, there is a half depreciation. More than 180 days, there is a full depreciation. There is nothing here. You have to take the date of purchase and accordingly number of days you have to ascertain till the end of the accounting year or provide depreciation. Like that, date of sale, beginning of the year till the date of sale, you have to provide depreciation on a pro rata basis. Then depreciation for 2 and 3 shifts useful life is for single shift. What has been given to you in the schedule 3 is applicable only for single shift. If there are assets which is used for double shift, 2 shifts or triple shift, 3 shifts, you will have to provide more depreciation. You can provide more depreciation, but there are some assets for which phrase like NESD is mentioned in the schedule itself, no extra shift depreciation. Therefore, for those assets, the depreciation mentioned in schedule 3 only can be provided, or the useful life only is the understanding, and depreciation accordingly is worked out. There is no extra shift depreciation. No extra shift depreciation is NESD. Otherwise, if that NESD is not there, and if that asset is working for double shift, you can take 50% more than the single shift. If single shift depreciation is 5 lakhs, you can add up another 2.5 lakhs as depreciation for the double shift. Similarly, if the asset works for 3 shifts, then if single shift depreciation is 5 lakhs, you can add another 5 lakhs you can add for the other 2 shifts. Therefore, a 50% addition or a 100% addition could be made respectively for 2 and 3 shifts, provided there is no NESD mention in the schedule. If there is a NESD mention in the schedule, you can have only one depreciation, possibly a single depreciation only. No 2 shift or 3 shift is allowed for those assets for which there is a NESD prescription in the schedule. Component accounting. This was earlier there, even under the 1956 scenario under the accounting standard. But in the accounting standard, this component accounting is still optional. It is still optional. But what is exactly compounding accounting is something that you all of you might be aware. It might have been discussed earlier also. If there is an asset, a comprehensive asset, but the parts of the asset, some parts of the asset have a different useful life than the asset itself. Useful life specified in part C of the schedule is the whole of the asset, and where the cost of part of the asset is significant to total cost of the asset, materiality concept, and the useful life of that part is different from the useful life of the remaining asset, then useful life of that significant part shall be determined separately and depreciated separately. This largely applies to some assets like aircrafts. In aircraft, the substantial part of the aircraft is the body of the aircraft. In the aircraft, there is the aircraft engine. There are interiors like seats and all that. There are a lot of regulations as far as the aircrafts are concerned. The seats are to be replaced, say, once in 3 years. The engine is to be replaced, say, once in 4 years. The aircraft may come for 10 years. The aircraft's useful life may be 10 years. But compulsorily, the engines are to be changed once in 4 years, or the seats are to be changed for once in 5 years, let us assume. Even though the aircraft's useful life is 10 years, the components of the aircraft, namely the engines and seats, are required to be changed mandatorily for a less period of 4 years or 3 years. Then the useful life of the engine or the seats of the aircraft are different than that of the aircraft itself, which useful life is 10 years. In which case, a significant cost is incurred in developing the interiors like seats. A significant cost is incurred for the engine, and therefore the engine and possibly the seats are to be depreciated based on its respective useful life. Therefore, you have to have the aircraft depreciation done separately, other than the engine and the seats. Seats are to be depreciated separately, and the engine is to be depreciated separately, because the useful life is driven by law. If that is the case, then we have to account this depreciation based on component accounting. Therefore, component accounting are cases where one part of the asset, one part of the machinery, I would even put it like this: there is a machinery in which there is a big motor. If the motor's useful life is, say, 25 years, if the machinery's useful life is 15 years, if the motor life useful life is 25 years, if at the end of 15 years, if you can take out the motor and use it for some other purpose, then possibly, even though the machinery cannot run without the motor and therefore it is composite with that of the machinery, the motor's useful life is different, because the motor's capability is to get used for 25 years. The machine can come only for 15 years. The motor is inside the machinery, but you can remove the motor at the end of the useful life of the machinery and keep it separately and use it for some other purpose, which means a component of the machinery, that is motor, could be used for 25 years, and therefore the motor should be depreciated for 25 years. The machinery, other than the motor, the machinery cost should be depreciated for 15 years. This is what is exactly component accounting. It is not as simple as I talk. The componenting of an asset is extremely difficult. In some cases, I see that lift of a building is depreciated separately than the building itself, even though it might be difficult for you to remove the lift and all that. Sometimes in some companies, lifts are separated from building and depreciated separately. Component accounting is mandatory only for Ind AS entities, and entities in AS10. In AS10, it is not mandatory. In Ind AS 16, it is mandatory. To that extent, you should be careful. I would advise that have an understanding of components even in a small private limited company, if you can, because that's an optional understanding under the regular AS10. And just because it is optional, you can't say that I have not analyzed anything as to the asset, I have not componentized the asset, and therefore I am not going to do anything. Better have component accounting done. But if at all you feel that componenting accounting is difficult or componentization is difficult, you need not do. This is one important thing that has come about these days, especially in the COVID scenario, where we have to understand what is an MSME, because MSMEs are being offered lot of loans and facilities from the government and banks. But here under Schedule 3, the purpose is slightly different. There are certain disclosures that you have to make under Schedule 3 in your balance sheet or P&L account as notes to balance sheet or notes to P&L account. As far as what you owe to MSME, MSME is your creditor, disclosures are required. Before understanding what are all the disclosures that you have to make with respect to MSME, as far as Schedule 3 is concerned, we have to understand that what is an MSME is all about. The definition of a MSME. The definition of an MSME is there under the MSME Development Act, MSMED 2006. The definition of MSME is different up to 36/2020. After 31/3, but up to 36. Therefore, on 31/3, this definition is to be understood. Beyond 36 from 1/7, the definition is different. And again, most of you might be aware of the new definition of MSME, which also we will see now. We will see in the next slides. Up to 36/2020, or for the balance sheet that you prepare or the P&L that you prepare for 1920, as at 31/3/20, this definition is important. Manufacturing entities based on investment in plant and machinery. Micro enterprises, investment does not exceed 25 lakhs. If the investment in plant and machinery does not exceed 25 lakhs, the investment means cost as per books. Micro enterprises, 25 lakhs, then you are micro. If it exceeds 25 lakhs but not exceeds 5 crores, then you are small. If the concerned MSME's investment in plant and machinery exceeds 5 crores but does not exceed 10 crores, it is medium. Up to 25 lakhs micro, 25 lakhs to beyond 25 lakhs up to 5 crores small, and beyond 5 crores up to 10 crores medium enterprises. This is manufacturing entities. Then for service sector, based on investment in equipments, there it is plant and machinery, this is equipment, because in service sector, it is unlikely that you have something called plant and machinery. For micro enterprises, investments in equipments up to 10 lakhs does not exceed 10 lakhs or up to 10 lakhs. Small enterprises beyond 10 lakhs but not exceeding 2 crores. Medium enterprises beyond 2 crores but does not exceed 5 crores. So there is a definition for manufacturing entity. There is also a definition for service industry. Unfortunately, trading industries earlier and even today are not covered under any trading organization cannot have the facility of MSME. They can't be called as micro, small or medium enterprises. They are just trading concerns. None of the facilities that are given to MSME are available to trading. The bankers now are advised to decide and go about lending to trading sector. The central government has informally agreed to accept to the request of traders to ensure that they are also putting the definition of MSME. But as of today, MSME doesn't include anything of an entity which is just a trading entity and not doing any manufacturing or services. This is the definition up to 36/20. There is a revised definition from 17/20. Here, both manufacturing and services are clubbed. The earlier definition of MSME up to 36/20, it is two parts. One definition for manufacturing and part 2 is the definition for service enterprises. Now, all services, manufacturing, everything is bundled together. Here again, there is nothing of a trading entity inclusion. Therefore, even today, even after that 1720 amendment as to definition of MSME, trading entities or trading companies are outside the purview of MSME. Micro enterprises, investment in plant and machinery or equipment. We did see that plant and machinery is relevant for manufacturing enterprises, equipment is relevant for service enterprises. Now they have clubbed all that together. There is only one definition of MSME under the new definition, one understanding, 1 crore up to 5 crores, not more than 1 crore, and annual turnover of not more than 5 crores. There are two packages now. Plant and machinery or equipment not more than 1 crore and annual turnover of not more than 5 crores. This condition is cumulative, which means if your investment in plant and machinery is not more than 1 crore, but if your turnover is 6 crores, you are not micro. If your turnover is 4 crores, but investment in plant and machinery is 2 crores, then also you are not micro. Therefore, these two conditions are to be cumulatively satisfied. The investment should not exceed 1 crore. The turnover should also not exceed 5 crores. These two conditions are to be satisfied cumulatively together. Then only will be called as a micro. Similarly, for small, the investment in plant and machinery or equipment is not more than 10 crores. Sorry, not more than 10 crores and annual turnover of not more than 50 crores. Then medium enterprises, investment in plant and machinery or equipment not more than 50 crores to 50 crores. That should be 10 crores and okay. Medium enterprise, I think there is some mistake in the first micro. Not more than 1 crore, annual turnover not more than 5 crores. Okay. Between 5 and 10, yes, between 5 and 10 it is small. If it exceeds 10, then it will become medium. Not more than 50 crores and annual turnover not more than 250 crores. So micro, small and medium definitions have been changed only from 1720. When you finalize the balance sheet of this year ending 31st March 2019, please ensure you follow the earlier definition. The earlier definition talks of investment in plant and machinery or equipment. There it is cost as per books. Unfortunately, in the new definition, the cost will be cost as per income tax return. The income tax return cost is taken. Popularly, the income tax in the income tax return are there additions every year. You will give the assets that are acquired under plant and machinery or equipment. Under the head additions, there is a cost over there. But there could be some issues as to understanding of cost as per books, understanding of cost as per income tax act. But the earlier definition of MSME up to 36, the cost is ascertained based on books. Here the cost is ascertained based on whatever that you give in the income tax returns of the current year or in the earlier years. That is what they say. We'll have to wait and see whether this gets changed or not. But today, the definition or the threshold limits of 1 crore, 5 crore, 10 crore, 50 crores, etc. are based on the additions that you give in the income tax return form. But please ensure that to understand micro, two conditions are to be cumulatively satisfied, both in terms of investment and also in terms of turnover. So investment limit in equipment or machinery and turnover limit, both conditions should be satisfied together. You can't have one condition met and call yourself as micro or small or medium. To put simply, if your turnover is more than 250 crores, you will be outside the definition. If your investment in plant and machinery or equipment is more than 50 crores, you are outside the definition of MSM, micro, small and medium. Therefore, any entity where the investment is more than 50 crores, they are not MSME. Any entity where the turnover is more than 250 crores, they are not MSME at all. Therefore, this is one larger definition, and some entities might be out of MSME because they don't satisfy one of those conditions. The disclosures related to MSME under the Companies Act on the face of the balance sheet. That face of the balance sheet is important. In the balance sheet itself, you will have to give the total outstanding dues to micro enterprises and small enterprises. You have to disclose it separately. How much you owe to the MSMEs. Medium enterprises, unfortunately, is not covered, but I would prefer to include that medium enterprises also, because later the notes require disclosures related to medium enterprises. Therefore, let us understand in the balance sheet itself, in the main balance sheet itself, what are the trade payables, you have to give the dues to MSME fully. These are all additional disclosures required. The principal amount and interest due thereon remaining unpaid, the amount of interest paid by the buyer, etc. All those relates to interest payments due to largely principal. Also you have to give interest payment. All of you must be aware, if there is a delayed payment to MSME, there is a disallowance under the Income Tax Act. The disallowance is not because of any provision under the Income Tax Act. If you look at this E, if you look at the E of this slide, point number E of this slide, the disallowance is mentioned in section 23 of MSME Development Act 2006, the last one. The disallowance is not mentioned in the Income Tax Act. The disallowance is mentioned in the section 23 of MSME Act. If you pay a belated interest to an MSME, possibly the entire interest will get disallowed under the Income Tax Act. For the purpose of disallowance of deductible expenditure under section 23, of course, the disallowance will be made under the Income Tax Act. The problem here is any payment due, I would, there are so many 15 days and all that, a point a day and all that, but I would put it like this. If a payment is made to an MSME beyond 45 days, then possibly an interest will be automatic, even though there is an agreement to pay the entire amount in 60 days. The credit period may be 60 days or 90 days. But the MSME Act says you have to pay within 45 days. If your agreement is 30 days, fine. If your agreement is 15 days, fine. If there is no agreement, it will be taken as 50 days and all that. But nevertheless, there can't be a payment to MSME beyond 45 days. If you do that, you have to add up some interest and pay. The interest is 3 times the bank rate and all that. Whatever interest that you pay will be disallowed under the Income Tax Act also. The Companies Act Schedule 3 demands disclosure of all those details of interest, principal due to MSME separately, beyond mentioning in the face of the balance sheet the due to MSME separately, main balance sheet itself. Of course, the fixed assets up to 2018, we were understanding something like fixed assets. Today it is known as property, plant and equipment. So please mention property, plant and equipment instead of fixed assets in the balance sheet. Non-current asset, fixed assets. Don't mention fixed assets. Property, plant and equipment is the new wording. This has come about in 2018 because the point is very simple. If you mention fixed assets, there's nothing wrong. But sometimes as I said in the beginning, the Ministry of Corporate Affairs or the CA institutes might warn you for not doing something like this. It's a very small thing. You would have mentioned fixed assets, but you have to mention property, plant and equipment. They will put it as a remark. So to avoid all those unpleasant scenarios, please understand that it's no more fixed assets, it's property, plant and equipment. 2 years have gone by. If you understand, this changes come in 2018. But some cases you may not be changing it as a matter of routine. You would not have seen a perfunctory understanding sort of a thing. Let it not exist. Please be careful. Please change. If the company is covered under section 135 relating to corporate social responsibility, the amount that you spend or the expenditure that you have made to satisfy the CSR activity expenditure should be separately shown in the statement of profit and loss. CSR expenditure should be separately shown in the statement of profit and loss. Now, these are all the important points that I wanted to discuss as far as Schedule 3 is concerned. There are certain more important points. I thought you must be more aware of the routine points that you have to cover. There is one guidance note on Schedule 3 also issued by the Institute of Chartered Accountants of India. That guidance note is very handy. Please go through that guidance note when you finalize the balance sheet and profit and loss account of a limited company. But certain points which demanded attention, I thought I should share with you. We will proceed to audit. Now, accounts, my part of presentation is over. Any questions on that, we can take up later. Audit under Companies Act, the salient points. The Companies Amendment Act 2017 has provided that ratification for audit appointment is not required. You must be aware of section 139 of Companies Act, where an auditor can be appointed only for a 5-year term if he's an individual, for a 2 period of 5-year terms if the audit is done by a audit firm, for a partnership firm. So for an individual, 5 years appointment is valid. For an audit firm, 10 years appointment is valid, but it should be 2 terms of 5 years each. For each year, in between these 5 years or 10 years, for each year, earlier, there was a requirement of ratification. Every year, the shareholder has to ratify the appointment and continue with the same auditor. That is not required since the passage of Companies Act 2017. Possibly from 31/3/19, we are not doing any ratification at all, and therefore you need not have to include a business of ratification of appointment of auditor in between those 5 years or 10 years as the case may be. Auditor not to render certain services, section 140. This is a very serious section. We will come to this later. You are not supposed to render any other services other than the audit service, and please take proper care to ensure that you don't render any service beyond the audit service. Whatever services that are prohibited to be done under section 144, please ensure that you don't do. Rotation of audit applicability to private companies, that also we will see. International internal financial control reporting, IFCR, that we will see to which companies they are applicable. Then the CARO applicability to private companies also we will see. Auditor not to render certain services, section 144. Auditor not to render accounting and bookkeeping. So if you are an auditor of a company, you should not render accounting and bookkeeping work of the company. You should not do accounting and bookkeeping of the holding company of the company that you are auditing. You should not do that work for the subsidiary company. So all these prohibited services should not be done for the same company or for the holding company or for the associate or joint venture or subsidiary companies. Internal audit, obviously you can't do. Design and implementation of financial system, this you can't do. Actuarial services you can't do. Investment advisory you can't do. Investment advisory services you can't do. Investment banking you can't do. Outsourced financial services you can't do. Management services is a broader term. I'll come to that later. Management services to the company. Hello. Hello. Outsourced financial services you can't do. Management services to the company you can't do. You can't do all these services to its holding company, subsidiary company. I would even say associates and joint ventures. To those companies, you can't render any other services like bookkeeping or internal audit or actuarial services or whatever beyond the audit service. The directly or indirectly through his relative or any other person connect or associate with such individual through any other entity. It is not that you should not do. It is also that you should not indirectly do through the relative. Suppose I have an audit and bookkeeping services are done by my wife. Hello. Hello. Yeah, there is a disturbance.
Sorry for disturbance, sir. Actually, we muted it.
No, can I continue? Sorry. Can I continue?
Definitely, sir. You may continue.
Okay, okay. It is not that you are not supposed to do only. It is that you should not even do indirectly through your relative. You can't appoint your wife as internal auditor, or you can't appoint your relative. Relative definition is there in the Companies Act itself, 214. There is also some related party disclosure rules. There the relative definition is there, and you have to ensure that if that relative definition is satisfied, then your relative cannot also do all these services. Any other person connected or associated with such individual or through any other entity whatsoever in which such individual has significant influence or control, or whose name or trademark or brand is used by such individuals. Therefore, a direct rendering of all these services is prohibited. You should not also render indirectly these services. This is just to mention that these are all the things that are there, and please ensure that you take care. If you are already doing something, ensure that you take care properly and accordingly give it to somebody else. In case of auditor being a firm, either itself or through any of its partners or through its parent, subsidiary, associate entity, and all that, again, the question of relationship will come here indirectly, directly by the firm and indirectly by partner or relative of the partners and all that. Management services, what is management services has been a point of debate. What exactly management services? There are a lot of definitions. The ethics says something. There are some opinions given that some work could be done, some work could not be done. But to me, it looks like this. Project reports, you can't do. CMA data preparation, you can't do. you may assist them. If they ask them what should be done, you may assist them. Preparation you can't do. Project reports you can't do. Filing of ITR, TDS, GST return would all be construed as management services. My understanding of management services is like this. If some work could be done by the company management itself or company staff itself, and if that work is outsourced to us, for example, a project report can be prepared by the company management itself or by the company staff itself. The CMA can be prepared by the company. ITR can be filed by the company. TDS returns can be filed by the company. GST returns can be filed by the company itself. Instead, we are doing it. Therefore, something of a work that the management itself can do, but you are doing the work because it is outsourced to you. That is prohibited if you are an auditor, or if your relative, as an auditor, if your relative does it, that is also prohibited. Therefore, ensure that you are documenting properly any work that is being done, not falling within your ambit or your relative's ambit, to understand that you will be hit by section 144 and you might have serious consequences if there is a related party transaction like this. Therefore, ensure that these works are not done straight away, directly or indirectly by the concerned auditor. The bills are raised in some other company, and let some other company do that work, and you or your relative should not do the management service. Most of us, some auditors keep doing this TDS returns or GST returns filing, but ensure that you float a company where you or your relative are not there as partners. Let that company do the work. Then there is something called rotation of auditors under section 139(2). 5 years individual can be appointed as an auditor. After 5 years, he has to vacate office and some other individual should come in. Similarly, for 10 years, a firm can be appointed as an auditor, first 5-year term and second 5-year term. Beyond that, they can't be appointed. This is the general rule. But are there any exceptions for this rule? Yes. Then a new auditor should come in after 5 years or 10 years. Are there exceptions? Yes. Unlisted public companies with paid up capital of less than 10 crores, private companies with a paid up share capital of less than 50 crores, exempted from rotation of audit, which means an individual doing an audit of unlisted public companies with a paid up capital of less than 10 crores or private companies with paid up capital of less than 50 crores. An individual appointed for 5 years will retire at the end of 5th year. Again, he can be appointed for another 5 years. This is the understanding. Therefore, no rotation is required. Again, after 5 years, they can again be appointed. Therefore, the same auditor can continue for many number of years, except that beyond 5 years, he can't be appointed. At the end of 5th year, he retires and he can be again reappointed. If rotation comes, then at the end of 5 years, the same auditor cannot be appointed. But for these unlisted public companies or private companies with a paid up capital of less than 50 crores, rotation is not there. But for these two unlisted public companies or private companies, you must also ensure that borrowings, bank deposits, borrowings, financial borrowing, public deposits, all that is not exceeding 50 crores. 50 crores or more, or yes, 50 crores or more, if that is the borrowing, then the exemption is lost. Paid up capital is less than 10 crores or paid up capital is less than 50 crores as the case may be, but borrowings are more than 50 crores. Or borrowings are 50 crores or more. In such cases, this exemption will be done. Therefore, if your borrowing is 55 crores, you may be a private company, but you are liable for the rotation. If your borrowing is 55 crores, you may be an unlisted public company with a paid up capital of 9 crores, but because borrowings are more than 50 crores, you are out of this exemption and a rotation would be applicable. Therefore, ensure that for those companies where the paid up capital is less than 10 crores unlisted, or paid up capital is within 50 crores private companies, please ensure borrowings are within 50 crores. If it is 50 crores or above, then the exemption is lost. Then that is as regards the routine appointment of auditors, etc. You should not render management services either directly or indirectly. Now let us come to audit report. SA 700 is the main standards on audit. There are a lot of standards on audit relating to audit and preparation of audit report, but audit report as such, SA 700 governs the audit report. Again, it has come about last year, 31/3/19, and we have been doing it for the past 1 year, and all of you must be aware of it. beginning 1/4/18 and onwards, financial year, which means for most of us, financial year beginning 1/4/18 ended on 31st March 2019. From that, the new SA 700 is applicable, or the revised SA 700 is applicable. The audit report format, there are 5 illustrations of audit reports given in appendix to SA 700. For most of the private companies, because Erode or Coimbatore, private companies will be largely in number, and we would be auditing those private companies only. The illustration 3 given in SA 700 would be taken. My advice would be just to follow line by line what is given in illustration 3. Don't ever change anything given in the illustration, because a lot of queries come in again from MCA or the ICAI as to why you have done this, why you have done this. It is not mentioned in the format, or the format says something, you have done it differently. So don't be too very casual while you prepare the audit report. I would even say that it is a just cut and copy paste to the extent possible. Whenever you want to do something more or less, please be careful, but then maintain the lines or the wordings given in the standards on audit 700, and just follow the same wordings. Don't ever change the format. In that audit report on accounts is one thing. Audit report on internal financial control is another thing. Audit report on accounts, all the companies auditors are to report on the accounts, whether the balance sheet reflects true and fair view, whether profit and loss account reflects the true and fair view of operations during the year, whether cash flows reflect the true and fair view of cash flows that has occurred during the period. All that, yes, it is there. That is applicable for all companies. Beyond that, there is also one reporting that is required as to whether the internal financial controls are there in the company and it is effectively functioning. That reporting we will have to do. Is it that all companies have to do IFC reporting? Not necessary. There are some exemptions also for reporting of internal financial controls over financial reporting. Private companies which are OPC and small companies, to those private companies which are 1% companies or small companies, IFC reporting is not required. Then this is what is important. Private companies with turnover of less than 50 crores as per the latest audited financials, and borrowing from banks, financial institutions, body corporate of less than 25 crores. If a private company's turnover is less than 50 crores and borrowings are less than, both are again cumulative. So your turnover has to be 50 crores. Not only that, your borrowing should be less than 25 crores. Less than 50 crores of turnover, less than 25 crores of borrowing, then you are out of IFC reporting. If turnover is 40 crores but borrowings are 30 crores, IFC reporting will come in. If borrowings are 20 crores but turnover is 60 crores, IFC reporting will come in. If both your turnover and borrowings are less than 50 crores and less than 20 crores respectively, then you are out of IFC reporting. This is what is IFC is all about. If you have to follow IFC, if IFC is applicable, please follow the guidance note that has been published as to how exactly. It's a very complex guidance note. Internal financial control reporting is complex. It's not that very easy, but there is a routine understanding on that. That needs a larger discussion. But please understand that there is a guidance note available. You have to go through the guidance note and accordingly pick important points, ensure that there is an internal financial control over financial reporting, so that the financial statements are not misleading or does not contain any misstatements. This is what is IFC. Then CARO 2016 also there are some exemptions. I was asked to talk about CARO 2020. Initially when the chairman contacted me, he wanted me to discuss on CARO 2020. I told him CARO 2020 is postponed to next year, and it is from today to March 21 is a longer period, and therefore discussion on CARO 2020 would not be very ideal at this point in time, because the first CARO reporting will come in after 31st March 2021 only, when the audit reports of March 21 are to be finalized. I told him instead, let us take up something relevant to current year, and therefore all these points are being discussed. So I'm discussing CARO 2016 and not 2020. The same kind of exemptions are available even in CARO 2020. Exemption from CARO 2016 private companies. A private company which is not a holding or subsidiary company of a public company. For all public companies, CARO is applicable. And if you're a private company, and if you're a holding company or a subsidiary company of a public company, then independent of anything, you will have to follow, or the auditor of that private company should also report under CARO. A private company having a paid up share capital and reserve and surplus of not more than 1 crore as on the balance sheet date. As at the balance sheet date for 31/3/20, if paid up capital plus reserve surplus doesn't exceed 1 crore or not more than 1 crore, then CARO is not applicable. CARO 2016 is not applicable. And it is not just that. And a private company does not have total borrowing exceeding 1 crore from any bank and financial institution at any point of time during the financial year. So borrowing threshold is 1 crore. A private company which does not have total revenue exceeding 10 crore during the financial year. Therefore, if you are a private company where the sum of paid up capital and reserve surplus are less than 1 crore, and that is one condition. The second condition, again, cumulatively to be complied with, total borrowing should not exceed 1 crore. And further, you have to comply with one more third condition, your total revenue should not exceed 10 crores. If all these conditions, 2, 3, 4 together are satisfied, then you are out of CARO reporting. To that private company, the auditor need not report on CARO, even though the company is required to follow all those that is mentioned in CARO 2016. Similarly, internal financial reporting exemption is available for the auditor. There is no question of reporting. But should the company to follow internal financial control? Yes. Even though the auditor is exempted from reporting, the company is required to follow, and to some extent, the auditor is also responsible to ensure that internal financial control exists. Like that, there are a lot of clauses in CARO, and the auditor is responsible to ensure that whatever that is mentioned in CARO is also strictly followed by the company, but we are not required to report on anything. To that extent, our risk drops. But is our risk zero is a question. No, our risk is not zero. Whatever that is mentioned in CARO should also be done with for a private company. Whatever that is required for internal financial control also to be followed by a private company. We are absolved of reporting either under IFSC or here, depending on the thresholds that the private company met. So please understand that and accordingly proceed. But the risk is lesser because we are not supposed to report. This is what is CARO exemption is all about. Illustration 3 on SA 700, which largely applies to most private companies. It is applicable only to a standalone company. Group audit, it is not applicable. This illustration 3 is applicable only if there is an opinion that you are making which is not qualified. A qualified report or a modified opinion report, illustration 3 is not applicable. You should also see something more and then accordingly prepare the report. Applicable if there is no significant concern on the going concern assumption should not be set to doubt. In this scenario, which I will come to later in this COVID, how exactly you have to go about in understanding going concern is a difficult thing. I'll just discuss later for 5 minutes about that. But if there is no management opinion on going concern, or if the auditor also feels that the company is a going concern, then you can pick this illustration 3. Applicable if there is no key audit matters to be specified. Key audit matters is applicable only for listed entities as of now. Unlisted public companies, private companies, there is no requirement to mention key audit matters by the auditor, and therefore this illustration 3 will be applicable only if there is no key audit matter. If there is a key audit matter, a different illustration 1 is applicable. Applicable if there is no material misstatement in other information. Other information relates to something not being a financial statement. There is a board's report. There are certain other reports given in the accounts, what we call as annual report. To put simply, there could be some board report where they refer to sales, where they refer to profit, where they refer to dividends paid. So in a board's report, there are a lot of mention about financial results, dividends paid, etc. Now that is a corroborative information. There is a dividend provision in the financial statement. There is also a dividend mentioned in the board's report. There is a turnover mentioned in the financial statement. There is also a turnover mentioned in the board's report as a matter of information. Now you have to corroborate these information and ensure that the turnover mentioned in the financial statements are the same as that of the turnover mentioned in the board's report. We are not responsible for a board's report. It is responsible to the management. But if there is a difference between turnover mentioned in board's report and the turnover mentioned in financial statement, this other information reporting will have a bearing. But broadly, the board's report and the financial statements like turnover or dividend rate has to coincide, but please ensure these things are coinciding and accordingly state that as far as other information, everything is same, there is nothing to report. But it is applicable if there is no material misstatement in other information. If there is a material misstatement, then you have to state accordingly that other information like board report carry a different figure than because of the reasons that is mentioned by the board. It is unlikely that something like that is to crop up. There are 7 paragraphs. First paragraph is an opinion as to balance sheet or statement of state of affairs, P&L, profit bar loss, changes in equity, only if applicable, only for Ind AS, and cash flows. How do you arrive at the opinion? Other information I have already discussed. Responsibilities of management, auditor's responsibilities, other matter, branch auditor being different. You might be auditing a company where the and one of the branch of the company is located somewhere else like Mumbai or Chennai or whatever, and that branch is audited by a different auditor. That this is the example that they have given. And in other matters, please specify to the extent of branch financials. I've just compiled. I've also taken some affirmation from the branch auditor, but beyond that, there is no responsibility for us because it has been just consolidated with the head office. Then report on other legal and regulatory requirements. 143.3 requirements that you have done this, you have done that, you have ensured that accounting standards are followed and all that. That report you have to say lastly. Therefore, there are 7 paragraphs in SA 700. Please ensure that you phrase the paragraph in a similar manner. First should be opinion, then it should be basis for opinion, other information like that. 1 to 7 in that order. Please ensure that you give the report. Ensure that audit report is dated and signed on or after the date of authentication of financial statements by the management. If the management signs the financials on, say, 3rd of June, you can't sign it on 2nd June. It has to be either 3rd or later to 3rd of June. So you have to date the audit report either on the date of financial statement signing by the management or a later date, not an earlier date, because these things have occurred in what they call as common errors notes in audit report and all that. Whenever there is a peer review, things like that, there are reports given by the peer reviewer, and there is a compilation given by the Institute of Chartered Accountants where they mention all these are errors creeping up in the audit report. Both the FRN of the firm and the MRN of the partner signing the report to be mentioned in the report. If there is only individual, you will have only MRN. If there is an individual signing on behalf of the firm, then you have to mention both the MRN and the FRN of the firm. Ensure that you opine on profit or loss and not profit bar loss. Sometimes we miss to cut. This is a very small error. A lot of us do it. We say that the profit or loss for the year without cutting profit or loss. So if it is profit, you say profit, loss you can strike off, or if there is loss, have loss, keep the loss, strike off the profit. But sometimes we just don't bother and we just say profit bar loss, and that is very bad. You should either say it is profit or loss, but don't just leave it as such. Profit bar loss sort of a phrase should be avoided, which is very common. Give correct captions for paragraph report. This is what they say, and ensure that the captions as given in SA 700, which is available very much in the website of the institute, is taken. Heading of audit report, it has to be, they are very particular that you have to mention independent auditors report and not just auditors report. Independent, even though it is slightly heavier or it looks slightly out of place, but better you mention independent auditors report or not just auditors report. Say independent auditors report. Ensure that an opinion is given for cash flow statement also if applicable. So first see the applicability of cash flow statement. For most of the companies it will be applicable, and ensure that you prepare cash flow statement, see it, management signs, you also sign, and give an opinion on the cash flows also. When modifying a report or qualifying a report, give reasons, quantify the effect, or go by management estimates. Suppose if gratuity provision is not made, then probably you may have to qualify the report, because for a company which has been in existence for 5 years or more, for which the Gratuity Act would be applicable, there is a provision for gratuity required, maybe under actuarial method or some other method. And if the company has not made the provision for some reason, you may have to qualify. If you say that if you qualify a report or if you modify a report by giving a qualification, then you have to give the reasons why you are qualifying, what is the amount of provision that they have to make if you have an independent valuation, or if you are not able to independently value but management has given some estimate, but somehow they have not provided, go by the estimates given by the bank. Therefore, a qualification has to be in detail in the main audit report itself, have the qualification done as to reasons, quantification, and also if there is no quantification, the estimates that you have relied upon given by the management. CSR rules, CSR provisions of Companies Act 2013. For most of the companies, again, smaller companies, CSR may not be applicable. But I thought, the chairman asked me to include CSR also, I thought I should just add it up and explain to the best of my ability. Applicability, section 135(1). Section 135, the Companies Act deals with corporate social responsibility for certain entities like net worth of 500 crores and above, turnover of 1000 crores and above, net profit of 5 crores and above. The third condition of net profit of 5 crores and above is slightly lesser, and some companies may be making a profit of 5 crores and above, to which the CSR provisions will apply. Otherwise, the net worth has to be 500 crores and above or turnover of 1000 crores. Please note that it is R, which means if your net worth of 500 crores or above, it will apply. Your net worth may be smaller, but turnover may be larger, then it will apply. Your net worth and turnover could be smaller, but net profit is very high at 6 crores or 7 crores, then the CSR provisions will apply. That these figures are to be taken with respect to the immediately preceding financial year. For 31/3/20, it will be 31/3/19 that will be relevant. These companies to which the CSR provisions apply are required to constitute a CSR committee consisting 3 or more directors, out of which at least one director shall be an independent director. If there is an independent director, then one of such directors should be there in the CSR committee. 3 or more directors should be there. Independent directors are required, obviously, for listed companies. Independent director is a must. Certain high turnover or high net worth public companies, there is a requirement of independent director. It is not for all companies an independent director is required. For listed entities and some other unlisted public companies, a requirement of independent director is there under section 149(4). To all those companies, an independent director who is there in the board should also find a place, at least one should find a place in the CSR committee. Board's report should disclose the composition of CSR committee, who are all the members of the CSR committee, who is the independent there, the director there. CSR committee shall recommend CSR policy. What exactly CSR policy we'll see later. Policy shall indicate the activities to be undertaken on areas specified in Schedule 7. Therefore, you can't just like that have any policy of your choice. There are certain activities which are construed to be corporate social responsibility activities, CSR activities, mentioned in Schedule 7 of the Companies Act. Those activities only will form part of the CSR policy. Schedule 7 also I will briefly give you. Recommend the amount of expenditure to be incurred on the activities referred to and monitor the CSR policy of the company from time to time. The board has to ensure that the committee recommends the amount of expenditure, and the committee also monitors the CSR policy of the company from time to time. Of course, board will be on a larger scale responsible for both. I did tell you that the CSR activities, the policy should be based on activities to be done. The CSR activities are mentioned in Schedule 7, a larger schedule. I'll just read out. Eradicating hunger. If a company incurs expenditure to eradicate hunger at large in the country, then it is a CSR activity. Eradicating hunger, poverty, malnutrition, promoting health care, including preventive health care, sanitation, contribution to Swachh Bharat activities, promoting education, special education, employment of NSC, vocational skills. Broadly, all these are social welfare measures, and if a company is going to spend on all these activities, it will become a CSR activity because it is permitted under Schedule 7. Promoting gender equality, empowering women, setting up homes and hostels for women, daycare centers, environmental sustainability, ecological balance, all these, clean Ganga Fund, all these are CSR activities. All these are mentioned in Schedule 7. Protection of national heritage, art and culture, etc. Measures for the benefit of armed forces, training to promote rural sports, contributions to Prime Minister's National Relief Fund or Prime Minister's Citizen Assistance Relief in Emergency, PM CARES Fund, that is very the topic of the day, or any other fund set up by the central government for socio-economic development and relief and welfare measure of scheduled caste tribes and other backward classes, and monitoring of women, contribution to incubators funded by central government of all these institutions, IIT is there, ICMR is there, CSIR is there, all that is there. Rural development projects, slum area development, disaster management, including relief and rehabilitation of reconstruction activities. There are 13 activities that are mentioned over there in schedule 17. A broad list has been given to you, and those activities will be anything other than that is not a CSR activity. The board of every company to which section 135 applies, after taking into account the recommendation made by the CSR committee, approve the CSR policy. So there has to be a CSR committee. They will have to discuss among themselves and formulate the CSR policy. Then it should be given to the board. The board has to finally approve the CSR policy and disclose the contents of such policy in its report. So there are a lot of activities mentioned in Schedule 7, and the CSR policy would broadly tell how much is the expenditure to be spent on all these activities, either individually or piled together. And the board's report every year should include all those details as to the CSR policy, and not only the board's report, in the company's website, it should be ensured that all these activities are properly displayed. This is very important. The spending, how much is the spending? All these companies to which 135 applies, section 135 applies, should spend at least 2% of average net profits. Net profits are to be divided in accordance with 198. 198 also applies to calculation of manager remuneration. In the same manner, you have to compute average net profits made during the 3 immediately preceding financial years, or where the company has not completed the period of 3 financial years since its incorporation. During such immediately, if it is only 2 years, take the average of 2 years because the company is new, or 1 year if the company is new. Otherwise, it is 3 preceding years. You have to take the average and work out 2% of average profits. So develop CSR policy, form CSR committee, develop CSR policy, recommend it to the board. The board or the company has to spend 2% of the average profits of the past preceding 3 financial years in a particular year as to CSR activity expenditure. The company should give preference to local areas and areas around it operates for spending. If the company fails to spend the 2% of average net profits of the past 3 years, if worked out in accordance with section 198, the board shall in its report specify the reasons for not spending the amount, and unless the unspent amount relates to an ongoing project referred to, transfer such unspent amount of fund specified in Schedule 7 within a period of 6 months of the expiry of the financial year. So 31st March 20, they have spent only 1.5% or 1.75% of profits. Another 0.25% or 0.5% remains to be spent. Now there is a project that is going on and this will be spent further, then there is no problem. Otherwise, if it is not identified for any ongoing project, it has to be kept separately and it should be transferred to a fund like we do for dividend, unpaid dividend account. Later in one slide, we will see that it is unspent CSR fund account and all that. You have to open a separate bank account and transfer that unspent amount to that account within 6 months after the expiry of the financial year. That is what I told you. There has to be an unspent corporate social responsibility account to which you have to transfer at the end of 6 months. Within 30 days from the end of 6 months, you will have to transfer the money that you have unspent. Now, if there is an ongoing project and you are going to spend it within 6 months, there is no problem. But if there is no ongoing project, but you have not spent all the amount, there is something that does not meet, the spending does not meet the 2% criteria, then unspent amount is to be transferred to a special account like dividend, unpaid dividend account and all that. And it has to be spent by the company later towards CSR policy within a period of 3 financial years, failing which it will go to a fund specified in schedules to PM CARES fund or PM relief fund. All that fund you will have transfer, like you have investor education and protection fund, which is possibly 7 years if the dividend is unpaid or if the deposit is unpaid for a longer period of time. After some time, you transfer it to the IEPF, investor education protection fund. Like that, you have transferred it to a PM relief fund or a PM CARES fund within 30 days from the date of completion of the 3rd financial year. So within 3 years, you have to complete it. If you don't complete it, it can't lie in unspent corporate social responsibility account in a bank, you have to transfer it at the end of 3 years, within 30 days, you have to transfer it to that separate fund account like PM Relief Fund mentioned in Schedule 7. Every company, including its holding or subsidiary and a foreign company having its branch office or project office in India, which fulfills the criteria specified in subsection 1 of 135 of the Act, shall comply. It not only applies to the company, if it is subsidiary to the holding company also it will apply. If it is a holding company to subsidiary also apply. A foreign company might be having some operations here and they might have registered with MCA and all that, a branch office. Even though there is no company existing here, a project office or a branch office of a foreign company will also be construed as a company, and accordingly a registration is required under the Companies Act. To those companies also these provisions would apply. If the company ceases to be a company covered under, if the threshold limits are not met in a particular year, then you can't just stop. You can't come out of 135 in the same year. You have to wait for another 3 consecutive years. For all those 3 consecutive years, if the thresholds are not met, then you can dispense off with your CSR committee, and all other requirements under section 135 will not apply to you. Therefore, you may come below the limits specified under 135 and you may be out of the CSR provision, but you can't take that option immediately. If you are under the CSR provisions earlier, you have to wait for 3 more years. Like this accounting standards also, if you are going to come out of some provision, you should continue following that provision for 3 consecutive years. If all the 3 years you are exempt, then finally 4th year you will be totally out of that provision. Instead of doing by the company itself, this expenditure can be done by a Section 8 company formulated by the company or formulated by the central government. Instead of spending the CSR money by the company directly, you can also float a Section 8 company and do it, or you can also give it to a Section 8 company floated by the central government or the state government. That is permitted. But if there is a Section 8 company that is not floated by you, or that is not a government company but some other Section 8 company, then you can give it to that Section 8 company which is different. You are not a member there and you have not floated the Section 8 company, or your holding company has not floated it, but it's a very different Section 8 company not belonging to you. Then you must establish that Section 8 company to which you give the money for CSR expenditure, there is a track record of 3 years. To put simply, you can do it yourself, the CSR expenditure, the company can itself do it, or it can give the fund to a Section 8 company which is floated by the company itself or its associate and all that, or it can give the fund to a Section 8 company floated by central government or state government. If the money is given to some other trust which is a Section 8 company or a trust, and if the trust is a very new trust, that is not permitted. If that trust has got track record of 3 years for the programs mentioned in Schedule 7 and all that, then to that Section 8 company you can. Therefore, if you are going to give the money to a rank outside a trust which is a Section 8 company or some other registered trust, that ensure that at least 3 years have passed since the formation of the trust, and there is a track record of doing those activities in that trust for a period of 3 years. If you yourself are going to form a trust, you can do it yourself, or you can give it to a trust formulated by the central government or the state government. 2-3 companies can jointly do, but they have to maintain proportions. That is what they say. Report separately on such projects or programs in accordance with the rules, which means you have to spend 2%, the other company should also spend 2%, and you have to maintain proper books to ensure that the spending by you is 2%, the spending by the other company is also 2%. Like the requirements under Income Tax Act under Section 11, the spending of the CSR projects or programs or activities should be done only in India. You can't spend for activities which are similar to CSR activities outside India. It has to be done only in India. Related party spending is not allowed. There are some spending which are restricted to 5% of total CSR expenditure of the company in one financial year. Personal expenses, salaries, like in income tax, you can't be spend a lot of money for administration of trust without spending for objects of the trust. if the donation received by a trustee is say 10 lakhs, 9 lakh is salary, another 50,000 is printing and stationery. Like that, you can't say that I've spent all the 10 lakhs of donation received for charitable activity. There has to be larger portion of the spending towards the objects of the trust and not for administration of the trust. Like that, companies may build CSR capacity of their own personnel as well as those of implementing agencies to institution, but the spending should be restricted to 5%. Largely, the spending should be for CSR activities and not for administration. Political party, you can't give, shall not be considered as CSR activity. Okay, this is obviously Schedule 7 requires compliance. Board's report should be very exhaustive as to whether they have compiled with the CSR provision and the rules from thereon. In case of foreign company having a branch in India, ensure that the balance sheet filed under Section 381 shall contain an annexure reporting on CSR. I did tell you a foreign company is not obliged by Indian company law, but if they have a branch in India, it is construed as company and the registration under the Companies Act required. To those companies, CSR activities or CSR spending would apply. Okay, website, you have disclosed everything. There is a guidance note also on the CSR activity, whether provision for unspent amount required to be created. We did see in a slide that a company is not required to spend all the money of 2% in 1 year, but it has to transfer the money to an unspent account within 6 months after the end of the financial. That money is to be spent. Otherwise, you have to transfer it to a separate account and all that. Now, the company has not spent, and is it that the company has to create a provision for the unspent amount? No, that is not required. If there is an unspent amount, if it is for an ongoing project also, the unspent amount will be there. But there is no provision. In fact, you should not create a provision unless there is a requirement under AS 29, whereby there is a creditor. You have spent, but you have not paid the amount. If that is the case, a provision for liability could be made. A provision for unspent amount, if there is no liability, there is an amount that you have not spent, but there is no owing to anybody. There could be a salary payable or a payable to some party in connection with the spending of CSR activities. If that is the case, the provision is obviously required. That provision is allowed, but you have to spend 50 lakhs, you have spent only 49 lakhs, you are to spend another 1 lakh. There is no provision required. You should not create a provision, or the company should not create a provision. Only the board is required to disclose the unspent amount. There is no provision, or there should not be any provision made for the unspent amount, is what the guidance note says. Whether you have spent 2.5%, can we take that 0.5% to next period and spend only 1.5%? No, that is not possible. You are required to spend 2%. If you spend more, it is your choice. But you can't carry the excess of 0.5% to another year and say that the next year I'll spend only 1.5%. Since 2% of average profit is immediately preceding 3 years, the minimum amount which is required, the excess amount cannot be carried forward, required to be spent in future. Obviously, it is a every year application. You have to spend 2% profits every year, and surplus of 1 year cannot be carried forward to the next period. All these are to be properly disclosed. CSR expenditure should be disclosed separately as a line item in the CSR expenditure. You don't have a, in Schedule 3, there is no place to mention CSR expenditure separately. Therefore, have a separate line in the P&L and book the CSR expenditure or present the CSR expenditure thereon. The CSR expenditure breakup also should be given. Purchase of asset, other expenses should be given in the notes. These are all the various points that I wanted to discuss on audit, accounts, audit, and the CSR provision broadly, just to enlighten you the various provision. I have not touched upon the intricacies. I have briefed you only the fundamentals as to accounts or audit and the CSR provisions. Intricacies I have not taken. This is to exhibit the provisions contained in the Companies Act or in the guidance note as to audit, applicability as to CARO, applicability as to IFCR and all that, and not a very deep discussion on the applicability. Before closing up, I thought I should spend some time on the COVID-19 issues. Time and again, right from March 2020, the Institute of Chartered Accountants of India has been giving various guidances or advisories as to COVID-19 disclosures. In fact, there are disclosures, there are guidances as to how to maintain your office. There are guidances as to how to understand the leave taken by the apprentices during this COVID-19 times and all that. All that are there in very much in there is a COVID-19 page itself in ICAI, clear COVID-19 page, where all the circulars or the notifications or the guidances given by the ICAI are put in one page. You can click each link and accordingly understand what you are supposed to do. As far as public companies which are listed is concerned, there is a very specific guidance by SEBI. There is a circular by SEBI which tells them what they are supposed to do in preparation of financial statement, what disclosures that they have to make in board's report, auditor's report and all that. There is a SEBI requirement that has come about somewhere in March 20 or later or May 20, I'm not very sure. But there is a SEBI circular mandating all listed companies to give appropriate disclosures as to COVID. But so far, there is no requirement for private companies from MCA as regards COVID-19 disclosures. Can we just say that there are no disclosures for COVID-19 as far as private companies are concerned because there is no guidance by MCA? No, I would say as no. It is better at least to cover our risk. We should have to disclose something in the audit report or ensure that the board mention something in their board's report and accordingly make a mention in the audit report also. I'll just briefly discuss in 5 or 10 minutes this point. The first scenario indicates material uncertainty about the entity's ability to continue as a going concern. So this problem will come only to those industries or companies or organizations which are hit by COVID. For example, there could be a big factory which has not been functioning for a larger time. Till date, they have not opened. Which means will they be able to continue in the near future would be an issue. There are certain companies which are not that very affected by COVID. Therefore, the continuity of going concern is not a very big issue for them. So certain concerns, certain private companies, certain partnership firms, you might have a doubt whether this firm will continue or the company will continue. In such cases, you have to be careful to understand the going concern. In the second scenario, there is no material uncertainty about the entity's ability to continue as a going concern, although it is expected that the impact of COVID-19 might be significant but uncertain. That is in relation to expected future performance, effects on future asset valuation of entities, general, etc. In third scenario, it is expected that COVID-19 may have some impact, though not significant. So first is some companies are very largely affected by the COVID-19 scenario. Maybe a college or a school which is run by a limited company or a routine company which has exposure to some debtors or creditors which is affected by the COVID, but that exposure is not very big, therefore going concern is not in doubt. Very limited impact only. There may be certain companies where there is a positive effect of COVID-19, like pharmacy companies or medical shops or whatever, big medical shops, where possibly the impact of COVID-19 is a positive. Even in such cases, the SEBI says you make a disclosure as to what is going to happen. Therefore, almost all companies have an impact. It could be a listed company, it could be an unlisted company, it could be even a small firm. When we do tax audit, we will have this issue of inventory, whether inventories are verified physically, whether the closing stock quantity is correct. In such places, it is better we mention because of COVID, no inventory verification could be done on 31st March. Normally, we say books of stock register are not painted, we are unable to give quantity details and all that. This year, ensure that you take more care and make appropriate disclosures wherever you sign an audit report, be it a partnership firm, be it a limited company, be it tax audit report and all that. In that direction, there are a lot of guidances given by the ICAI. You please read everything and come to a conclusion. So this is how you have to break it. I would put it like this. There is a balance sheet that you prepare on 31st March 2020. There is also a P&L account that you prepare as of 31st March 2020. And Whereas the cash flow statement will also fall in place as for the year 1920. These are three financial statements that you normally see: a balance sheet, P&L, and the cash flow statement. All these are prepared under the assumption of going concern. The balance sheet and P&L distinction itself is coming because of going concern. If in a liquidating concern or a company which is going to get closed, there is no balance sheet, there is no P&L. It is only statement of affairs. All assets and liabilities are taken. The realizable values of assets and settlement values of liabilities are only shown. What we call a statement of affairs. Those of you who remember what you have done in CA intermediate or earlier in foundation, liquidation of companies chapter, there is one statement of affairs that you will prepare. Expected realizable value of assets, expected settlement value of liabilities, what the ultimate shareholders will get, how much is preferential creditors are going to be given, how much is secured creditors are going to be given. That statement of affairs only you have to prepare if the company is not a going concern. A balance sheet with realizable value. In a going concern, a balance sheet with realizable values you don't prepare. Mostly it is book value, but there is a fair value understanding also. In case of India, it is more stress. Cost or market price, whichever is lower. All those concepts are there. But in balance sheet, you carry only book values or not realizable values in case of going concern. In a concern which is not a going concern, everything is on realizable value basis. Therefore, that is predominant. And therefore, to come to a conclusion whether it is a going concern or not, and then the P&L account will look very big this year. Because up to 31st, only somewhere in 24th or 15th or maybe from March 1st, there was a problem. 11 months of the previous year, the COVID issue was not very prevalent. Only in the last month and now from April, we are having this uncertainty. Therefore, the P&L account of last year might look very good. The balance sheet of last year might look very good. In fact, the balance sheet might look good. Most of the balance sheet could be financial assets, like there will be debtors, there will be creditors, there will be some bank balances, there will be some advances given. Whether all these are going to get realized, what we call a subsequent event. You have to make a call and accordingly ensure that the assets shown in the balance sheet or the liability shown in the balance sheet could have a dent, could have an impairment. Those things are to be considered and appropriately disclosed. Let me not get into the larger issue of how exactly we have to proceed, but please ensure that you put a small line. There are a lot of balance sheets available now for listed entities, like you have balance sheet of Reliance, you have balance sheet of TCS, you have balance sheet of very many companies which has come about. I did see Crompton Greaves and all that. There are mention about this COVID. What is the audit report that they have given? What is the board's report that they have given? Small points you can take and even put it in a private company. This is my advice. Maybe in another 15 days or 1 month, MCA might come out with advisory. ICAI might also come out with more advisories, and accordingly take those advisories and prepare your audit report. But please ensure that you state something in the auditor's report as to how exactly you look like the financial position or the P&L account as far as COVID-19 impact is concerned, because COVID-19 impact is later after 31st March 2020, which report, audit report is prepared only now. So you will have to look at what has happened after 31st March 20 and accordingly give your opinion on the going concern or assets or liabilities or the operations of the company. If there is a larger impact, you will have to give. If there is a smaller impact also, you can say that. These are all the various links. Impact of coronavirus on financial reporting and auditors considered. There they have not mentioned listed companies, unlisted companies and all that. Clear? In financial reporting and auditors consideration, what is the impact of corona? Accordingly, you'll have to deal with. Then going concern, key consideration for auditors amid COVID-19, that link is also I have given. Then there is a physical verification of inventory, assets, etc. amidst COVID-19, how exactly we go about. Then key audit consideration, subsequent events is very important. What we call as events occurring after balance sheet date. Clear? So this AS4 and India AS10, those standards, AS10 is on events occurring after balance sheet date. India AS10 is events occurring after reporting period, that is subsequent events. So whatever that has happened after March, from April till date, could affect the position on 31st March, because balance sheet is something that is on a projected base. These are all my receivables, these are all my fixed assets, this which we are going to use later. These are all my receivables which I will collect later after 31st March. If the fixed assets have an impairment, if the debtors have an impairment, if the stocks that are there on 31st March is sold for a very, very low value after 31st March. All these invite attention of the auditors and accordingly attention of the management also. My advice will be ensure that the management represents everything properly in their board's report. You can take those reports into consideration and make a mention in your audit report, say under emphasis of the matter, unless you disagree with what they say. Most of the times we have to agree because there is a big uncertainty. We can't also evaluate the impact. The management itself will not be able to evaluate the impact. But there should be a note, even saying that there is a big problem. We are not able to understand anything bigger issue in this company, but there could be some smaller impacts like that. That you mention in the emphasis also in what is called emphasis of the matter paragraph. So ensure that you do all these things, follow all these links. There is a specific page in ICAI. Please do that. It will take only half a day or 1 day. Have a notes prepared based on whatever the guidance says and accordingly follow it later. If we have to understand what exactly we have to do, we have to have one more seminar to understand all this. It is more of a discussion that we have to do. One man's opinion may be correct or incorrect. With this, I complete my session. Hope my session would have been of some use to you in preparing the audit reports or in finalizing the financial statements of a company for the year ended 31st March 2020. Obviously, 31st March 2021, it could be a different scenario where CARO 2020 would become applicable. And accordingly, we will have to learn the CARO 2020 also. I thank all of you for a very, very patient hearing. Thank the Erode branch for the opportunity given to me. Thank you very much.
Thank you, sir. Sir, we have a few questions through message. Shall we read it, sir?
It is there in chat, sir.
Yes, sir. Yes, it's
One
chat.
minute, I'll open.
Okay, sir. From 4:10 onwards, we have a few messages.
I'll do that. I'll do that. I hope they are there in the screen. They are still there or they have left out?
Sir, still there.
So
All the
Jairam Natarajan.
Yes,
Is that the first question? Jairam Natarajan.
That is the first question, Jairam, sir.
Good evening. Annual return filed for March 2019 as a defect wherein shareholders list is erroneous. Can we resubmit the forms after appending the correct shareholders list? I don't think there is a resubmission facility available there. I don't think so. The problem in unlike in income tax where you can always revise your income tax return, you can't revise your forms under MCA. You will have to go to ROC, explain the reason, and if possible, ROC might give you a window, or you will have to go to the next authority, the regional director's office. We can't probably revise the any form for that matter. Any form for that matter cannot be revised. That facility is not there in MCA. If somebody here has more idea about this, they can always participate. But in my opinion, you can't resubmit the form after appending the correct shareholders list once it is accepted. If it is a run-through process form, if it is already accepted, you can't do anything about it. You will have to go and request the ROC to ensure correction or to resubmit the form, either ROC or the regional director. So I would advise you to meet the, I have not done anything so far in this regard. I will not be able to further give you the idea, but I don't think there is a resubmission facility available in the website of MCA directly. Hope Jairam Natarajan is clear as to what I am saying. There is one phone number that has been given. Beyond that, there is nothing. Arjun Kumar Parekh. Chairman? Hello?
Sir, just leave it, sir. Kindly go to next question, sir. They're putting their,
can the useful life of an asset be changed so that the rate of depreciation changes after 2 years? Definitely you can change, but you must have to have reasons. See, the useful life is a yearly review. You can change every year also, but there should be consistency. And if you deviate the consistency whereby you are assessing the useful life of an asset as 10 years in 1 year. Suddenly at the end of 2 years, you understand it is not going to last for 10 years because of subsequent event that has happened after purchase. The useful life is not 10 years, it is only 8 years. You can now revise the useful life. You can change the rate of depreciation, do everything. Absolutely no problem. The only issue is You must have to have valid reasons to change the useful life. And accordingly you can change. In fact, you have to review the useful life every year. You can't take 15 years of useful life and keep providing depreciation for 15 years the same figure under SLM or WDV. That is not permitted at all. Everything is to be under yearly review. Therefore, yes, you have to do it, but there has to be a reason. You can't arbitrarily change the useful life. Just because you want a lesser depreciation or more depreciation, you can't change the useful life at will. An arbitrary change is prohibited. A change that is required because of change in accounting standard or because there is an expert opinion to understand, sir, you have earlier taken 10 years. At that point in time, it was all right. Now I find it is going to come only for the next 5 years. Please change it to 5 years, which means 2 years is passed. There is no more 8 years from now on. It is only 3 years. In another 3 years, the asset will depreciate fully. Therefore, please change the useful life. You can do that. Definitely, you can do that. There is no problem. Please ensure that you put valid reasons. It is also mentioned. It is also mentioned.
Two more questions is there, sir.
Yeah, 1 minute. Whether different method of depreciation can be adopted for the same class asset or different class of the, yes, very much possible. See, asset depreciation is asset basis and not group basis. There can be one plant and machinery which useful life is 15 years. There can be another plant and machinery which useful life could be 10 years. So it is not for group, it is for, again you have to differentiate. If the plant and machinery, one and plant and machinery two looks very, very same, why you take different useful life for the two different assets, you have to explain. But as a matter of policy, it is not that you have to group plant and machinery into one head and follow the same useful life for all the plant and machinery. Not necessary. For the same class of asset or for different class of asset, you can have different useful life, different depreciation, but everything is to be logically justified. Arbitrarily, nothing could be done. As per notification dated 26 June on MSME, value of plant and machinery is linked to IT Act. What does this mean? This is the problem. Should we reckon the WDV? No, it is not WDV. It is cost based on IT Act. It is a very difficult exercise that one has to undergo. You will have to see the cost of various years and come to a conclusion whether you are in the threshold of micro or small or medium. It is not certainly WDV. It is cost. There is a separate clarification given by the MSME as a FAQ. In the FAQ, they have said that you have to take the cost only, but it should be as per income tax return. Originally, everybody was thinking it is WDV. They have said cost only, purchase price, but go by ITR. Because for MSMEs, which are possibly not companies, you will not have anything except the ITR. Partnership firms or some other entities which are not limited companies, they might have WDV only in the balance sheet. The only way to ascertain the cost from an external evidence is income tax returns. Therefore, they have chosen to have income tax return as the basis of ascertaining cost. There also, you have to go by additions only. 2019, what is the addition? 2020, what is the addition? 2018, what is the addition? All plant and machinery are equipment additions. Year by year of ITR, you have to add and see whether you are in the threshold of micro or small or medium. It is certainly not WDV. There is a specific FAQ that is there, which you can go through and conclude that there what is mentioned is cost and not WDV. It is not WDV at all. But it is also mentioned that the value is the invoice value. That's what I'm saying. It is not WDV, it is cost. They have not said anywhere WDV. They have said the additions of the figures of additions mentioned in the ITR will be taken. They have never said WDV anywhere. No, because you have to go by the balance sheet. I don't think that borrowings will possibly, you are asking borrowing costs include non-funded limits. Now, as far as borrowing under the Companies Act is concerned for this CARO or wherever you see IFC and all that, the borrowing is based on balance sheet figures. I don't think there will be a balance sheet figure which is mentioned over there, but perhaps one should ensure that any non-funded limits which are later becoming funded, you should take. We go by the balance sheet figures, and borrowings is something that you owe the bank on a very firm basis. There could be a contingent liability because non-fund based limits might have been availed, but later it is not going to be settled at all from your funds unless you default. You need not take, but the CARO 2020 as a different point, they say limit sanction. In CARO 2020, the borrowing should be based on the verification of some data, like submission of stock statement is based on limit sanction, and therefore it will include non-fund limits also. As far as the various thresholds are concerned, non-fund limits you should not take. Whether CSR funds are donated to a trust, is the trust allowed to have a few other objects other than those stated in Schedule 8 also, but the funds have been spent only on allowed projects? Yes, there has to be a monitoring. The CSR, that trust should be carrying on those objectives for at least 3 years. If it is a clear outside trust, you must ensure that you are giving to a trust which is possibly knowing how exactly the activities that you are trying to do are under Schedule 7 could be done, because they are experienced in that. It is not that they will do only that activity. They should be doing that activity, and as a company you should also monitor the trust whether the amounts are, you must have to call for some vouchers or some letter from the trust that the expenditure has been spent for the allowed purposes. It is not that they have to be trust engaged only in that activity. That is not there. In the above question, the trust has the necessary track record of 3 years. Good. That is not a problem. You must ensure that the amounts are spent for the purposes for which the amount is given. The trust has Schedule 7 object, but also some other objects as well. Yes. No problem. It should have Schedule 7 objects at all. But if other objects are not totally disconnected, they might have some doubt. Totally disconnected and objects that are not really charitable or public, then there could be some problems that may creep in. But otherwise, if there are Schedule 7 objects that are available in the trust, there should not be any difficulty, I believe. Yeah. Any other questions there, Chairman?
Sir, there is no question, sir, still now.
Okay, we'll wait for another 5 minutes and then close.
Yes, sir. Members are requested to put your question through message.
They can also ask in the mic if they can.
Raise your hand. Yes, sir. Yes. We can unmute your mic.
Tata's story with Ford teaches us one.
Hope there is no question, sir. I think so.
Okay, sir. We can close.
Yes, sir.
I
Yes.
will again thank you and the other members of Erode branch who have been patiently hearing me. Hope I have done some justice to all of them. Hope to meet them again on some other day, hopefully physically. I would like to come to Erode and see all the members and talk. Let us wait for the unpleasant scenarios to end. Hope it ends soon, and hope to meet you all hope to meet all the members of Erode physically in the Erode branch. I always find it a pleasure to be there in Erode physically and talk to all of them. Thank you very much for a very patient hearing.
Thank you, sir. Thank you for your elaborate session.
Yes, sir.
I hear
Yes.
the request, Secretary Anand sir giving a vote of thanks. Anand sir, you are in line.
Sir, good evening, everybody. On behalf of Erode branch of SIRC of ICAI, I convey my sincere thanks to K.Bhadri Narayanan sir for his detailed presentation on account audit and CSR activities as per the Companies Act 2013. Thank you very much, sir. We are very thankful to you for your detailed presentation, and it was very useful interaction between members. Thanks a lot. I also thank all the members who have participated in this program and made it a grand success. Thank you, one and all. Thank you.